good afternoon, good morning, kalispera. Welcome. Thank you so much for being here with us today on our today's webinar on trading. The webinar is going to be in English today. My name is Maria Lyonnais, and I am Executive Director of Advancement and Alumni Relations at the American College of Greece. To those who are new to the ACG Alumni webinars, allow me to provide a very quick background. We started in April 2020, the webinars at the beginning of the pandemic to maintain and strengthen communication with our alumni, parents, and students through value-added activities that offer networking and lifelong development opportunities. The webinars are presented by alumni, parents of our school, industry experts, and students on a monthly basis on current topics that concern personal and professional development, technology, society, business, and much more. Our today's presenter is Oli Hochberg. Oli is a professional with 30 years of experience. He has held senior positions in sales, trading and money management between New York and London in Daiwa Securities America, Lyonnais Securities. He was ex-partner of Cantor Fitzgerald and BGC Partners. He was also featured in Reuters articles, Bloomberg Financial News, and Bloomberg TV. For the past 11 years, he has been an independent proprietary trader, and recently, he started eTrading Academy, an educational project focused on educating people on trading and investing. Today, he is going to share with us his 3 greatest tips about how to generate extra income from trading. At the end of today's presentation, we are going to have time for Q&A. And you can always write your questions in the Q&A section at the bottom of your screen, and any comments you may have during the presentation in the chat, which will be monitored by my colleague, Christina Hanju, who is also with us today. So, Oli, welcome once again. We are very happy to have you with us today. The floor is yours.
Thank you very much, Maria. Thank you for the nice introduction, and welcome everyone. I hope that everyone is in good shape today. So now before we get started, I just want you to know that I'll be mostly focused on the presentation, so I won't be looking at the chat window very often because we've got a lot of cover, and I'd like to make sure that we wrap it up within an hour, but don't worry, because like Maria said, we'll run a Q&A at the end, so you'll be free to ask anything that you want then. Also, I would recommend that you watch the webinar in full screen to fully appreciate the details of the PowerPoint presentation. So you should be able to find the full screen and arrows in the top right-hand corner of your Zoom meeting window. And if you can relocate my camera window to the bottom right of the presentation screen so it doesn't mess up with the slide. Okay, so welcome again. Really glad that everyone made it today, and you're probably here to learn a bit more about trading and investing in the stock market. And in my years of experience, I've noticed that very often people aspire to some kind of financial independence, long-term financial security, and the earlier that they can get to it, the better it is. Obviously, freedom of or financial security means different things for different people, but I strongly believe that trading, investing is one of the paths that can create that extra $100 or $200 a day, or even a lot more than that, and it can add up quickly. So today, hold on a second, because I'm going to have to, there you go. So today, my goal is to teach you my 3 greatest tips on how to generate this kind of extra income from trading, because this extra income can really basically bring you closer to achieve many of your financial goals. On a personal note, I've been working from a home office ever since I decided to leave the city of London about 11 years ago and move my family to a beautiful country being Greece. And to be honest, you know, it was mostly my experience and my knowledge of trading which enabled me to do all of that, because trading is one of these few activities out there where you can really generate decent income while being located anywhere you want. And also, I truly believe that it has never been so easy for retail traders like us to make the jump, because most of the tough barriers of entry are gone now. And by that, I mean that we have zero commission brokers. We get internet access almost everywhere. We can trade any financial instruments from smartphones, tablets, laptops on any stock markets that we want, which was not the case merely 10 years ago. So the cost of entries, logistics, everything has become a lot more accessible to the small investor. And also during this past year, we've lived through incredible times that even in my 30 years of professional trading career, I've never experienced before. And I'm specifically talking about the new power of the small retail traders. They have really collectively been able to generate incredible moves in the stock market with such meme stocks like AMC, GameStop, or even Hearst car rental, but also in many cryptocurrencies, simply by interacting as a group through the use of popular social media platforms, to the extent of sometimes really changing the overall order of things, and in some cases even bringing traditional finance like big hedge funds to the brink of bankruptcy, like we've seen in the case of GameStop. Popular trading platforms such as Robinhood, eToro, Webull, etc., etc. They've really democratized this field of trading and investing to the small player. And so perhaps some of you are at a crossroad right now. Perhaps, financial markets have always been something that you've been interested in, but never really got a chance to dig into. Maybe you're looking for a way to become more actively involved in your personal finance, investing process. And finally, perhaps you're thinking that further down the road, you'd like to make the similar jump like I did and start working for yourself as an independent trader. And regardless of your experience right now, I bet that you're thinking that learning more about trading could offer part of that solution to building a financial future. And as a matter of fact, you'd be totally right to think that, because it really can. So Christina is going to launch a quick survey in the Zoom panel now, and you should see it appearing somewhere on your screen in a second. Because I don't know where you are at this stage of your journey, but I'd like to understand if you're already trading, for how long you've been trading for, but anyhow, what I wanted to say is that I'm pretty sure that some of you today might also be brand new to it. And I just want to reassure you that, this webinar is really geared to everyone, being new starters to the game, but also slightly more advanced traders. And even if you know very little about stock trading, I assure you that with some decent education, you can achieve success. And so I hope that today's workshop will provide you with a nice intro to trading. I hope that you guys can bear with me until the end, because we're going to cover very interesting ground, and you'll learn a lot of practical stuff and tools on how to pick to pick those winners, in the stock market. And so, like Maria said, today's webinar, the subject is my 3 secrets, so my 3 greatest tips to successful trading. Now, the title sounds very impressive, doesn't it? And maybe I should have introduced it to with some sort of epic soundtrack, like Stanley Kubrick 2001 Space Odyssey type of soundtrack. But the title is great for marketing purposes. But I want you to understand something very important. There is no secret or magic formula about trading, and anybody trying to basically tell you otherwise is simply a charlatan. Because on the other end, there are definitely ways, there are techniques that, if implemented correctly and consistently, they will lead you the way to become good at it and making money from it. Again, there's no holy grail, but applying a methodology, common sense, hard work, that's what will lead you to success and making money in active investing. And like in any other field of activity, you'll need to learn. The same way that the pilots, they don't start flying from day one, or medical students, they don't operate on patients right away, thank God. In a similar way, learning how to trade stock and properly invest your portfolio requires the same sort of initial learning process, so that you don't hurt yourself by doing stupid things from the start and risk losing all your saving that you've worked hard for. And unless you prepare yourself the right way, then I believe that the odds are not going to be in your favor. I want to share something with you. And if you look at many different studies throughout time, you'll notice that almost 70 to 90% of people, they fail at trading. And these are real statistics. In fact, you should look at the small prints contained in the footer of most of the major broker platform websites. I'm showing that on the screen right now, because according to the law now, they have to disclose the percentage of losing accounts that they operate. And look, my goal is definitely not to discourage you or frighten you right from the start. But at the same time, I don't want to sugarcoat you and tell you that, it's all la vie en rose, because the reality is that trading requires dedication to learning. And I can tell you from my own experience that when you get started not knowing much, or worse, thinking that you know much about trading, then you end up paying the heavy price for not learning. I personally blew quite a few small accounts when I got started in this business, and I was young and I was impatient to make lots of money trading. And probably thank God that I was young with not a lot of money, because surely, the fact that I didn't have much to trade back then actually saved me from potential big losses. So trust me, I know what it means to get started while not being fully prepared. And to be honest, what actually saved me was the fact that I was, in that environment in New York, surrounded by a team of experienced traders who could guide me. And by the way, this is the most common characteristic of those who lose money at trading, that is not having much knowledge about it. And that's why, you find many beginner traders experiencing this high rate of failure and many frustration that goes with it, mostly because they lack the proper methodology to start with. So how can we help traders to get up there? That remaining 10 to 30% of people that make money on a consistent basis. Well, mainly by being with them all the way, by early in their journey, by providing them with a template and coaching them every day. That's what's going to help them the most, and that's what's going to basically shorten their learning journey. Again, there's no holy grail or magic formula, but simply a holistic, solid method which they will follow to start with, and then adapt to their needs and personality in due times. And I want you to know that working with like small groups of people along the years really made me realize how often can people start off with misconception about the markets, and also how much they can be irrational when it comes to investing. And it's not a fault on their own, because I think that our system of values, our beliefs, our society have fed our brains with a bunch of nonsense and myth about the way that we should invest or trade. And so there's a lot of work to be done out there, in order to demystify, to reprogram the way that most people think about the market and the way that they take action in the market. The reality is that, you don't need to rely on so-called specialists to make money in the market. All you need to do is to read a few good investment books, attend some seminars like this one, or investment classes, anything so you can build knowledge and confidence and learn how to invest using like sound principles and things that will build your investment portfolio over time, but also help you to protect from the bad times. Anyhow, like I said before, when I first started trading, I made most of the same mistake that perhaps some of you have made. But after 30 years being in this business, I can tell you that I've learned a hell of a lot from my own mistakes and the mistakes of my fellow traders around me. And I must tell you that if you want to be successful at trading and investing, first you will have to get rid of many of these bad habits of yours, which will feel very unnatural at the beginning. And I will explain you what I mean by that. For example, because it's in our human nature to want to be right most of the time, then we try to avoid taking a loss, because it hurts to admit that we were wrong. So we stay in a trade that has the potential of losing more and more money, and perhaps ultimately like eat up all of our accounts. Also, because many people are impulsive, and generally we don't like to plan too much in advance, then we just go for it without any plan in mind. But unfortunately, successful trading requires a very strict planning. Also, for instance, because by nature we're greedy, we tend to stay too long in an investment position. We think that the profits will just keep on piling up, but the reality is that they don't. At some point the market turns, it turns around, we just freeze like deers in headlights. We start watching the market reversing all the way down because we didn't have any exit plan. Or another example is that, people always like a good bargain. We like to buy things on the cheap. It's totally unnatural because of that feature. It's totally unnatural to bring ourselves to bring a stock making an all-time high. However, This is exactly because this stock is making a new high and outperforming every other stock that we should concentrate on this one rather than wasting time and money on the non-performing ones. So these are just a few examples of our natural inclination that are part of like psychological ingrained habits, which at the end of the day makes us our greatest enemy to profitable trading. Buying on the way up, cutting losers fast, having a defined strategy on how to manage our trades, all these important rules, they get mentally blocked out because we don't feel good about them. But again, let me reiterate what I was saying before. To be profitable in trading, we need to do the right thing and not the things that feels right. And don't worry if you recognize yourself in some of the situations that I just described, because, you know, like good old Michael Jackson used to say, you know, you're not alone. So even the most successful, the experienced traders, we still fight against our bad habits every day. It's a long learning process for everyone of us out there. But the start, you know, of our successful journey is to recognize our biggest flaws, our bad habits, and start acting towards not repeating them. And I strongly believe that human nature and the psychology of crowds have essentially remained the same over time. And both are directly reflected in the price action and the volume that you see in the stock market. So the same technical price patterns that you see in the market, they just keep on repeating themselves throughout history. And so, you know, the same financial bubbles that just keep on reappearing. So whether you call them the tulip mania, the tech bubble, the credit crunch, Black Friday, the COVID crisis, we call them by different names, but fundamentally, they're acting more or less the same way as they were 1, 2, or 500 years ago. So the techniques that I'm going to share with you today, they're timeless. They do not get out of fashion no matter what happens because they rely on our human nature. Once you've understood that you need to change your natural inclination, if you're willing to do what's right and not what feels right, if you have the motivation to study through, you know, hundreds and hundreds of price charts to learn about these price patterns, then I can promise you that you'll be on your way to successful trading and investing. And with that in mind, let's jump right into the main topic of this workshop. So we'll start with my number one trading concept sitting at the top of my list, and that's the 4 pillars of trading: psychology, risk, position, and money management. And I gave it the acronym of PRPM. And I know what you're going to be thinking right now. Gosh, you know, Oli's going to start boring us with this blah, blah about how risky trading is. Blah, blah, blah. But let me tell you something. We learn to preserve our capital first in order to then be able to make the real money. Then we go on learning to practice our strategy because, you know, capital protection should be our number one priority. Then everything will unfold the way that it's supposed to. I want to start by sharing this superb quote by this very famous hedge fund manager. And it sums up almost like everything about trading, but also it can apply to other aspects of life. And it reads like that: if you don't bet, you can't win. If you lose all your chips, you can't bet. And it's such a simple way of putting things, but so correct in many ways. Because, you know, in life, we take some risk, you know, in almost anything that we do. When we cross the road, we take a risk. When we take a plane, we take a risk. When we open a new business, we take a risk. Somehow, in anything that we undertake, we have to be careful not to get carried away or take overrated risk, because otherwise we might risk to lose it all. And so that is why we must first concentrate on how to protect our chips and then focus on how to multiply them. So really, these 4 pillars are essential to any investors and traders. They are really the strongest foundation for starting your trading and really taking it to the professional level. And funnily enough, risk management is the one ingredient that most beginner traders, they forget about. Or they just dismiss from the start. Instead, you know, many, they think it's okay, I can manage. First, I trade, I buy I press the buy, the sell button, everything goes green and red on my screen. It's all exciting. I'll worry about that later on. They start with the immediate assumption that they will be successful, that whatever they touch, you know, it will automatically turn into gold. But if it turns out to be a loser, you know, they don't really know how to deal with it because they didn't plan for it. And on top of that, you know, most of them, they think that surely, you know, it must be the market, which is wrong, because they couldn't possibly bring themselves to think that they could be the ones being on the wrong side of the market. So, you know, people don't want to question themselves because somehow it would hurt their ego. And that's essentially what separates the pro from the novice. For the professional trader, first priority is to know how much can I afford to lose on any particular trade. Once you understand the risk that that you're going to basically undertake, and you look at much you stand to potentially make if things go right, and then you decide whether the opportunity is worth a trade or not.
Oli, I'm sorry to interrupt. Would you like maybe to share the screen, or maybe I cannot see it? I don't know the slides.
You can't see the slide?
No. And I assume that before you mentioned that, yeah, now, exactly, okay.
It had disappeared. No, that was the same slide that I was under. Yeah.
Perfect. Now we can see it. Perfect.
Okay, super. Sorry, guys.
No problem.
So let me see. So, like I said, the professional trader, he has to decide first how much you can afford to lose on any particular trade, and then understand the risk, then how much it stands to potentially make when things go right. So then you decide whether the opportunity to take the trade is good or not. So everything, all the process has to be planned in advance. And I'm going to share this slide as well with you. Now, the reality of trading is that each trade is independent. Each trade basically is a random outcome. And that means that statistically, each trade is independent from one another. So whether, a particular trade is a winner or a loser, it's irrelevant in the grand scheme of things, because what matters is the positive edge of the strategy and how much you can expect to gain from it over time. But remember that, in order to succeed, in order to profit in the long run, it has to be the right balance between what you stand to lose and what you stand to win. So you see, what you really need is a combination of having a slight positive edge in the market and making sure that you control your risk. Because if you don't, then you will run the strong possibility of blowing your trading account even before having enough time or opportunity of making it. And so, we go back to making sure we always keep enough chips in reserves available for betting, because if we run out of chips, then, we can't play anymore. And what I mean by having a positive edge in the market, it's basically down to a methodology. It's a tested system of rules that needs to be followed before taking on any trade. So it might be that, we're 40% of the time correct, or 50% or higher. And the better, you become at it, the more consistent and higher the number will be. But the important thing is to have a system with this tiny little hedge. I'm sure that, you guys have heard of the old saying, the house always wins. And in the exact similar way that the casino has a slight hedge of maybe like 3 to 7%, depending on where you play the roulette, which, by the way, this small hedge has made casino owners very, very rich over time. We need to trade with an edge. This hedge that I'm talking about in trading, it's part of two key metrics that you'll have to monitor very closely. The first metric being your win ratio. So it's how many trades on average do we win versus the one that we lose. And the second important metric is called the payoff ratio. It's basically how many dollars on average we make for every dollar that we lose. So to use an example, say that we make on average $200 on our winning trades and we lose $100 on average on our losing trades. That makes this payoff ratio equal to 2 to 1. And one thing that's very important as well, as much as we can't control the outcome of our trade, like I said, the trades are random. Whether a trade will turn into a winner or not, the only thing that we can actually control with a pretty good degree of confidence is how much we're willing to lose on any single trade. And personally, I go even further by setting myself a maximum loss for any single day, week, or month. And this is this set of rules that make up my risk management. It acts like my trading account firewall. It is there to protect me from my own financial self-destruction, because by keeping a tight risk management, I can keep basically my boat afloat no matter what. Even if the ultimate ending is to blow my trading account at the end, these rules will keep me in the game for a long, long time, long enough that in the process, I will understand what are my biggest weaknesses, what I'm doing wrong, and the areas where I need to improve in order to become successful. So now I hope that I made it very clear that first and foremost we need to establish our risk control. But I'd like to show you how in reality we can use the power of these key metrics and statistics to our advantage. So let me show you this spreadsheet. On this spreadsheet, on this table, on the horizontal top, highlighted in blue, we get the win ratio that we just talked about. So basically, again, that's the average percentage of winning trade versus the losing one. On the left column that you can see, we have what we call the risk to reward ratio, also called the RR. So this risk to reward ratio is very similar to the payoff ratio that we've talked about just before. And let me explain. Remember that I told you that when we look at any potential trade, we need to decide how much we're willing to risk if we're wrong versus how much we stand to make if we're right. Well, that's exactly that risk reward ratio. If I decide to bet, let's say to risk $1 versus, let's say, the possibility of making $2 if I win, that's basically makes my ratio 1 to 2. And as you can see on this table, as long as we stick to trades offering a 1-to-1 ratio and above, most of the areas on the table, they're green or yellow, which means that we're either profitable or we're breaking even, no matter how wrong we can be. So my number one rule of risk management, you should never, ever consider a trade that offers anything below a 1-to-1 risk to reward ratio under no circumstances. And if you can stick with trades offering a 2-to-1 ratio, even better. So again, making on average $2 for every $1 that you put at risk. With that in mind, with that ratio of 2-to-1, you only need to be right 33% of the time in order to break even. Let me reformulate that in another way. You can be wrong 67% of the time and still come out okay, i.e. break even on your account, if you stick to trades paying you $2 for every $1 that you bet. Now, let me ask you, have you ever heard that before? Because me personally, I originally thought, perhaps like some of you do, that I needed to be right like 80 to 90% of the time in order to make money at trading. But then I realized that it was definitely not the case. And by the way, these numbers are not random. These statistics, they don't lie. They are real. They work in real life, in real trading. If you don't believe me, if you're still skeptical about this, then just Google the stats of the most successful traders or hedge funds with long track records, and you'll realize, like I did years ago, that even if you're wrong 67% of the time, you can still come out very profitable in your trading as long as you pick the right trades offering you a 2-to-1 risk to reward ratio or higher. Even the famous player and philanthropist by the name of Bernard Baruch used to say that you could be right only 3 or 4 times out of 10 and still be profitable if you know how to cut your losses quickly and let your profits run all the way. And I know it can sound illogical, but that's the reality of trading, because at the end of the day, trading is a game of numbers. It's just like the casino. So please try your best to get rid of all misconception about the world of investing, if you have any. And God knows that how many misconceptions we nurture, because personally, since we're kids, we've been raised competitively by our parents, the school, the society. They all try to teach us that we have to be right no matter what. The system has brainstormed us that making mistake is not a good thing, generally speaking. But I tell you this, it should not be like that, neither in life or in trading, because we learn tremendous lessons from our mistakes and bad trades. But especially in trading, if you're consistent, if you stay disciplined to your risk management, then you can still be successful and profitable despite being wrong loads of times. But now I want to take it a step further, and I want to show you that, contrary to common belief and what you can see all over social media, not only you can be wrong very often, but you don't even need to trade like large size or a large account in order to basically run a profitable trading business. So I'm going to show you on this simulation table. I play with a multi-dimensional aspects of the key metrics that we've just talked about and their impact on the return on investment, the ROI. So I'll spell you the details, but in a nutshell, if you look at what I consider to be the sweet spot between like 1,3, 1,5 for our risk reward ratio, which represent like a more realistic and achievable target for the average risk reward based on many trade samples, then I can aim at generating around 100% return per annum. And so, to summarize, being ready to lose $1 to make $1.40 on average, being right 60% of the time, so being wrong 40% of the time, I can still achieve around 100% return on my investment in my account if I use a strict risk per trade of around 1% of my start account value. And if I manage to execute one trade per day on average, that means like basically entering and closing that trade on the same day during 48 weeks of trading per year. I give myself like 4 weeks holiday. So again, for those of you who've been told that you need to trade big size or you need to leverage your account to the max to make money, and achieve performance, then look again at the results of this table and start basically rethinking about it, because it should be clear by now that you can risk a relatively small percent of your account size, less than 1% or close to 1% of risk per trade, while at the same time being wrong 40% of the time, and it's you will still be able to come out doubling your account after only a year. And that's what you will get if you're disciplined enough to cut your losses quickly, if you keep them small, if you're being patient to wait for the right trade signals, which offer that average risk reward, preferably above 1,4.
Oli, one question in order to understand it properly. So you said, if I understood correctly, 1% of risk means I can only spend 1% of my capital on a trade. Or is this?
Yeah, no. So 1% of risk doesn't mean that you restrict yourself to spend only 1% of your account. There's a big difference between saying that we want to risk, say, 1% of our account versus the actual size of the trade that we can take. These are two separate things that sometimes people mix up, but we're going to get to it in just a minute. So give me just a moment and you'll understand what I mean by that. First, let me just turn to the second feature of my core concept number one, which is money management. And money management is all about finding what is the right position size for your account. So as we've just discussed, I first need to set myself a maximum risk per trade, say 1% of my account. Then whenever I'm about to enter a position, I must have a predetermined level of exit. That is, I must know where I'm getting out even before I get in the trade. We call that level of invalidation the stop loss. And that's the point at which my trade has lost its rationale for still being in position, and at which basically I'm willing to stop myself out of the trade and get out, even if it means that I'm going to have to take a small loss. And by the way, that's how you keep your losses small, by not letting get them out of control, by forcing you out of the trade when you're wrong. So in a way, you understand that the position size is directly determined by the stop loss and my maximum risk per trade. But let me run you through a quick example. And at the same time, Maria, that will answer the question that you just had. Let's say that I'm willing to risk up to 1% of my account on any single trade. So let's say that I've got an account of 10,000. So based on the size of my trading account, I should allow myself to lose more. I shouldn't basically allow myself to lose more than $100 on any single trade. Again, it doesn't mean that I will buy for only $100 worth of stocks. It's just the amount of money that I'm willing to lose if I'm wrong. So, and let's assume that I've decided that my stop loss should be 50 cents below my entry price, meaning that I'm willing to bet 50 cents per share before admitting that I'm wrong. So with all that information, then I can simply calculate the maximum amount of shares that I should allow myself to buy, which is going to be basically $100, my risk, divided by 50 cents, my stop loss, and gives me basically 200 shares. So in this example, I would risk $100, which is 1% of risk per trade based on my account, but it doesn't mean that I can only invest $100 only in this stock. If the price of the stock, let's say, is $10, that would mean that I would spend $10 times 200 shares or $2,000 to buy that stock and get in position. But I still want to risk only $100 of that amount, which means that basically once the value of my position is below $1,900, I want out. And so now that I bought my 200 shares, what do I do with them? What's the plan? How am I going to manage my open position? So that basically relates to what we call position management. And that's what position management is all about. It's thinking about the exit strategies, meaning that we now carry a profitable trade. And so we need to plan on how to manage our paper profits through techniques such as like taking partial profits, time exits, trading stops, stops being moved at break even, et cetera, et cetera. Setting these exit strategy plans help me to find out whether I can get the minimum risk reward ratio that we talked about, 1-to-1, and whether I can afford to take that particular trade. But before we go any further, I want to open a quick parenthesis. You have to understand that I'm a technical trader, and so I mainly use technical analysis. That's where I base all my rules of trading. So apart from being aware of general news or any upcoming economic data or earnings report, my main concern is the price action and the chart that's in front of me. And so for those who are totally new, to the concept of technical analysis and charts, I want to introduce it very, very briefly so that everyone can be on the same page and understands how to read a very basic chart, and it will only take a minute, I promise. So most traders these days, they look at these charts that I've just shown on the slide now, using what we call Japanese candlesticks. Each candle basically contains 4 crucial points of information: the high, the low, the open, and the closing price of the stock. So on the left, you can see there's a typical green candle, meaning that the closing price is higher than the opening price, and that's the reverse for the red candle. And on the right, then you can see a typical chart, what a typical chart looks like. Here we have like the weekly chart of the New Zealand dollar versus the US dollar, where each candle basically shows the price action for each single week, red or green. So keep in mind that the unit of time that we have under consideration on the chart could be anything. It could be 1 minute, 5 minutes, 60 minutes, 1 day. So each candle represents the opening, closing, high and low price for a chosen unit of time. Also, another common feature that you can find on this chart are what we call the moving average, which basically simply helps to average and smooth out the price data. And it can be calculated over any specific period of time, again, being daily, weekly, or minutes. The most popular moving average used by traders are usually the moving average 20, 50, and 200. They're very popular, and so you can see them appearing on this chart. Now, back to the subject of position management. By looking at the chart that I'm just sharing with you now, and you understand basically the concept of candlesticks for those who didn't know, I decided that 50 cents was a good level to put my stop loss below my entry price. So stop loss will be at $9.50. If the next technical level on my chart shows an area where the price of the stock could meet some resistance, but still provide me with a potential profit of 50 cents, if I was to take some partial profit at say $10.50, then that means that I'm risking 50 cents to make 50 cents. And that gives me the minimum required risk reward ratio of 1 that I've told you, spoken to you since the beginning. And so I could go ahead with that trade. Then part of my trade management, I would keep part of the position I'm left with, and I would aim at a second area of profit taking at around $11.25, like you see on the chart, again, based on my technical analysis. If I manage to take profits there, that would mean that when I close my trade, my risk reward on that trade has just turned to almost 1-to-2 ratio, simply because I took 50 cents on half of my position and another $1.25 on the other half. So brings the total average profit of $1 per share compared to my 50 cents that I was risking at the beginning. So overall trade provided me with a risk reward to 1-to-2. It's a very, very important notion, and I can't even begin to tell you how this aspect of position management has literally changed my trading, because when I realized how much money I had left on the table over the years, simply because, I was always trying to swing for the fences. I mean, sometimes I was stubborn and I would hold on a bad trade for too long. After reviewing hundreds and hundreds of trades, I realized how important it was, at least for me, to scale out of my position and to be able to take partial profits, meaning, to cash in more often and remain at break even on the rest of the open position. Mentally, it helped me a lot to hold on it helped me basically to hold on my trades a lot longer. That was like one of these key moments where, my trading changed from being average to being consistent and profitable. And I had finally understood, that it was generally better to pay myself along the way and take some profits also, on the way up, rather than just going for the big home run. In general, I really do feel that investors are very bad at knowing when to sell and when to get out. And it's not only in the stock market, it's in anything, So, but again, it's mostly because from the start, they get into a trade without having any plan on how to manage it. So you see, now with, oh, sorry, I missed that thing. Now I want to show you the slide. I missed that slide. So showing you on that slide, the initial 50 cents risk, the initial reward of 50 cents, and then the second level where we reach 11 and a quarter, that basically transformed that initial risk reward of 1 to 1 to 2. Sorry, I missed that slide. So now that we've covered risk, we've covered money and position management, I want you to know that everything that we've discussed is only effective if we have the right psychology and the right mindset to start with, because all of these set of rules, they're only as good as the person having the will and the discipline to follow and execute them. That explains why psychology is such an important element and the fourth pillar of this PRPM core concept for successful trading, because trading is a game that takes place in your head. It's not you against the market like a lot of people will think. People that start thinking, oh, the market did it to me, or the market is. It's not like that. It's basically just you reflecting who you are in the market, and to that end, it is also one of the main reasons why finding a person that you can be accountable to is important at the start of your journey, because this trading game is so psychological that at the end of the day, traders, they need to talk and constantly exchange with someone that they can trust, someone that they can see through them, someone who understands trading and who can quickly understand the strengths and the weaknesses. But at the same time, it has to be someone who's not emotionally involved in their trade, so that this person can really act as a second pair of eyes, and be there to send you the warning when you veer off the correct path. So in conclusion, let's quickly recap what we've learned in this first set of essential trading concepts. First and foremost, we need to respect our risk, and then you set yourself a maximum risk per trade as a percentage of your account equity. I would recommend anything between 0.1 to 0.5% to start up with stocks, maximum nominal exposure of about 5%. You can double that for ETF because they're usually less volatile. I'm talking about non-leverage or over exotic ETF. Then we need to add layers to our firewall. So we set ourselves a max daily loss capped at 3 consecutive losing trades. So that means that the moment you eat 3 losing trades in a row, you're done for the day. You stop. And we also set a max weekly and a max monthly loss. Again, you have to understand that all these limits, all these rules, they act like a firewall to protect your trading account, mainly from yourself. So if or when your max risk limit, they're reached, then trading must be stopped, for the rest of the day, the week, or the month, depending on, which max loss is going to come first. And now we'll recap quickly the key metrics that we need to follow up in our trading. But I want you to keep in mind, remember that when you start, try to aim at being consistent rather than making money, because what you need at the beginning of your journey is to fully understand the methodology, to apply a process and follow a consistent approach. It's more important at the beginning not to lose money. And once you start reaching 2, 3, or 4 months, in a row where being flat or slightly profitable, then that means that you've started being more consistent in your trading, and you might be in a position to slightly start increasing your risk per trade slowly, like Siga, when we say, scale up your game. And so we need to aim at a win rate of about 50 to 60% to start with. That's the hedge that we have in the market. That's our extra probability that keeps the odds in our favor. The ultimate goal being to reach an average of around 70 to 75%, which is where you'll find most of the profitable traders. And finally, stick to trades offering, like I said many times now today, 1-to-1 risk reward ratio, with the ultimate goal to move to an average of 2-to-1. So this core concept number 1 of preservation of capital and consistency, they are key in trading. And remember that something essential, even small but consistent gains, they add up quickly to make big money in your account, especially if you're good at keeping your risk under control and to avoid all the big losses. So, all right, let's turn to my tip number 2 to successful trading, and that's the core strategies that I'm using. Let me just have a sip of water because I'm losing my voice now. I don't want to end up like the Godfather. All right, so sorry about that. I use 3 core strategies as part of my complete system, and the complete system is called the multiple time frame conversion system. I nicknamed it MTFC, which basically combines all of our core strategies and all the risk, money, and position management rules that we just reviewed. But we're looking through a broad spectrum of time frames. So we'll go over these core setups and the system, and I'll explain you roughly how they work together, what they intend to do. And I reckon that, from this summary, you'll get a good starting block for your trading, especially if you're not already using some of these setups. So let's get into it. And as a first reminder, I want to say again, there is no magic indicator. There's no magic strategy that works all the time. All the strategies are building blocks to a trading system. That's why I use a mix of these 3 core strategies. They can be adapted to many different time frames. So these 3 core setup, they cover the broad spectrum of market configuration, and they basically offer us several ways to trigger entries to our trades. So the first one is called major reversal warning, MRW. So this strategy basically tries to pick major turning points in the market. In concept, it's a contrarian strategy because we tend to go against the recent prevailing trend. We try to call a major turnaround top or bottom. So the drawback of this strategy is that it has a lower win rate when compared to the 2 other setups. But on the other end, it offers a much higher reward. Let me show you on the chart what MRW looks like. So you see, I'm going to show you on the chart, these blue areas that you can see, they're marked basically, and this is a weekly chart. So you have to understand that the time unit I'm using now is a quite long time frame. So these blue area, they marked areas where the market had a good turnaround. And that's basically what MRW strategy is looking for. Then the second core setup that I use, I call breaking loose, which is a typical breakout strategy, where we're playing the pushing through major point of price resistance and support, and we're betting on the continuation pattern of that breakout. So again, let me show you what it looks like on a chart, and we're talking about this sort of like, you see, we have a strong resistance here, and we broke that point of resistance, and suddenly we had a huge acceleration in the market. Likewise, on the way down here, we had many times this area of support, and suddenly the price cracked through, and we had a major breakdown. So this is the second setup that we're using, trying to basically play continuation pattern of these breakouts. And finally, the last one that I'm using, the last setup is called the B2T, the back to trend, which is basically a trend following strategy where we essentially play the major ongoing trend of a stock or stock market. And it's probably my favorite strategy because I think, I'm a trend follower at heart, and I've been for many, many years. And because also I believe above all that the trend is your friend. I'm sure that you've heard that expression, the trend is your friend. Also, generally speaking, this strategy, when applied correctly, it offers the highest winner rate of all 3. I'll show you basically how it looks like. Again, we have a very strong trend in an upward trend on that sector. And every time that we'll have these basically pullback here, these value areas that I call these value areas, these convergence areas here, you see that the market basically comes back. It comes back again and comes back again. So this is basically the third type of setup that I'm using. Now, let me go back and introduce you to the multiple time frame conversion system. And so what do I mean by multiple time frames? Financial markets, they consist of huge crowds made of very different players. And like I said, the way that I look at it is through the lenses of technical analysis. So in a way, everyone's emotions, everyone's fears and greed, they all filter through the price action. The volume that we study on the chart, they all represented there. So because the markets are so complex, the players are so different that we need more than one time frame to study them properly. The problem is that many people, they think that they can only focus on only one time frame, like say the daily chart, or perhaps short-term frame like the 5 minutes bar chart. And that is why most of these guys tend to lose, especially if they focus on only on the shorter time frames, because they miss the big picture. And not only that, they get messed up because they keep on switching time frames. So one day they might look at the daily chart, the next they might be looking at a 10 minutes bar chart. So sometimes one chart looks bullish, you want to buy, and the other one looks bearish, you want to sell. And the result of this confusion, is basically that their decision-making process is a total mess. They just don't know what to do. They don't know where to look for, when to enter or exit a trade. So remember my first warning that I had at the beginning of the webinar earlier. I said the highest rate of failure and frustration in trading mostly comes from the fact that people, they lack a methodology. So you need coherence in your trading. You need a complete map, a template to guide through these maze of markets. And for that, the multiple time frame conversions helps you to evaluate the context of the market, meaning it helps us to understand at point X in time where we are in the grand scheme of things. For that reason, we need to pull ourselves away from the market instead of like getting our nose stuck to the window, so we can get the big picture, and then we can micromanage the trade using the smaller units of time. So I'm going to run you through a real example of the MTFC system, and you can understand better what I mean by that. Here we're going to be looking at an example of swing trading on a stock called Arrowhead Pharmaceuticals, and I will use a multiple time frame combination of the daily chart and the 1 hour chart. So the first chart that you're looking at right now is the daily bar chart. We call that the screen number 1, which helps us basically to get the big picture, like I was telling you about, and to find out about the ongoing major trend, which basically ultimately sets our strategy as to what side of the market to play. Do I want to be long and buy the stock, or do I want to short the stock and basically sell that stock? On my screen number 1, I'm always looking for a nice convergence of factors that will help me to identify if there's like an ongoing trend. And so on this chart that you're looking at, you can notice that there's a steady rise of the stock price. It's making higher highs and higher lows according to the Dow theory. For those of you who know about the Dow theory, we notice a nice convergence of the moving average rising steadily, the stock price basically trading mostly above the 50 and the 200 moving average. And after a month long of the price correction around an important area that we see here, that's basically, we find multiple supports, such as like horizontal price supports, moving averages, etc. We get this convergence. We find the first trigger of that MRW entry signal that I was telling you about. So now that screen number 1 is telling us that our strategy is to be on the buy side of the stock move. We need to turn to our lower unit of time. In this case, I'm going to basically choose the 1 hour bar chart, also known as the screen number 2. And that's what's going to appear on the screen right now. So the idea is to start looking for entry points in the direction of the tide, but when the wave goes against the tide, which kind of really represent the best risk reward entry point that you will find. And we can start by identifying, some good points of entries here at the bottom of the chart. If you see where we can see those big green arrows, pointing out, to oversold levels on the stock RSI oscillator. At the same time, we find also a nice convergence here of price support levels and moving average again, and like we get the first series of pullbacks that triggers like the B2T entries. Also, you can find like some triggers of the breakout patterns that I just told you before, the breaking loose strategy. So you see, the advantage of combining multiple time frames is that it helps us to organize our thoughts in a constructive way. It really basically forces us to trade within the main direction of the market, either looking for micro counter trends, pullbacks, or breakouts coming out of these pullbacks. But at the end of the day, they give us multiple options for entry points.
Okay, I think Oli, I don't know about the rest, but I had difficulty understanding the 2 screens. So can you maybe explain these 2 screens again, screen 1 versus screen 2?
Sure. Sure. So the screen one basically gives you the overall trend direction and the strategy that you must follow on screen two. But screen two is used for your entry setups, where basically you try to find counter trend in order to get back within the main direction of screen one. So screen one gives you the main direction and strategy. From that, you know that you want to buy the stock and you're going to go to screen two. And screen two, basically, you will find an entry point. You will find the strategies that we discussed to find the best entries on screen two. So they basically, screen two is really the entry screen. Screen one is basically the overall macro view of the strategy. I hope it's a bit more clear.
Yeah, no, it's very clear. Okay.
So, and now for those who have more time to dedicate in front of their screens during the day, and so basically mostly interested in day trading, then you can fine tune the trade entry using like shorter time frames, such as the 15 minutes bar chart or the 5 minutes bar chart. When I'm talking about fine tuning, I mean to say that by going a step down from the 60-minute bar chart, we can find some slightly better priced entries and tighter stops. So if we look at this split window that I'm showing you, it displays the 60-minute and the 15 minutes bar chart side by side. We look back at the oversold areas on the 1 hour chart shown here, the same area that I pointed to you on the previous slide, right here under the magnifying glass, and the corresponding area on the 15 minutes bar chart, meaning at the exact same time. And here again, we can find on the 15 minutes bar chart, we can find plenty of great conversion signs to get long, to buy the stock. Things like an oversold oscillator, a strong support provided by the moving average 200. Finally, a Japanese candle pattern that I use a lot in my trading for entries, which is called the bullish engulfing pattern. And I'll show you basically what it means, but this enables me to get a signal and to go long to buy the stock once the price trades above the high of the previous candle. And then I can set a tighter stop that I would otherwise get on my 60-minute bar chart entry. So again, this shorter time frame requires a lot more attention and dedication in front of your screen. But if you do have slightly more time to dedicate, then it's definitely worth it. And this conversion system can be adapted to all sorts of time frames and trader profile. So I'm going to show you now on this table that I'm showing you. It's my recommended triple screen combination according to, adapted to your type of trading. So at this point, I might understand that some of you might be thinking, will I find time to trade? How am I going to basically deal with my full-time job and find the availability of putting the hours, to learn, to practice? And that's the reason why I'm suggesting this table with different combination of time frames, which basically will fit in exactly the way that you need them to fit in your actual current schedule. Now, if you can find an hour or so every day to dedicate to your trading, then you could follow the swing medium-term trader plan with a combination of daily and 1 hour time frame, like the example that we've just covered. If not, you could follow the long-term active investor plan, which requires some study, but only once a week. But no matter what combination that you choose, you will need to stick to it. And so let's say that you fit in the swing medium-term stock trader plan, and you want to use the daily and the 1 hour chart to get into the trade. Then you have to stick to these time units and use those time frames to get in and get out of the trades, because you're going to get tempted or distracted by the market short-term noise. And so, don't stop paying attention to the short time frames like the 5 minutes or the 1 minute bar chart. I know that the temptation can be great when you're looking, at the short-term trends, but that is why it's important to define from the start what's your favorite intermediate trading time frame that will suit your need for action, your personality, and most importantly, your time availability. All right, so quickly to sum up what we've learned in that second core trading concept. First, very important, primordial, you need to follow some rules in trading and have a plan of action. Then you use the multiple time frame conversions to get the big picture and trade within the main direction of the market using the 3 core entry setups. Then you need to adapt the multiple time frame, like I said, to your time availability and to your personality, so that there's a good match. And finally, I'd say pick one of the core strategies and stick to it, because you got to make it your bread and butter strategy, because you absolutely don't need to be a jack of all trades. All you need is one solid strategy that you master, along with a good, money management, risk management, and position management, all the core concept number one that we've covered. And with that, you're only one strategy away in order to make, good money on a consistent basis. And so now that we've talked about controlling and managing our risks, as well as having a set of entry rules, we finally come to the last chapter of this workshop, which is our third core concept for successful trading. It's about finding the right stocks to trade, or any other financial instruments. Allow me just another sip. Sorry. Thank you. So, as you know, there are many different financial instruments like stocks, ETF, foreign exchange, commodities, cryptocurrencies. I mean, the quantity is just simply, the quantity of candidates, to trade or invest in is just simply overwhelming. If you just take, for instance, the US stock market, we're talking about 20 to 25,000 securities. There are almost 50 different commodities that you can choose to trade, and more than 13,000 at this time, 13,000 cryptocurrencies to choose from. So trying to find the right stock or the crypto to play, it's like basically trying to find a needle in the haystack. That's a huge challenge that every trader faces, especially the beginner traders who don't really know where to start. So how many of you find it difficult to find the right stock to trade? Because believe me that I've struggled myself a long time. Before, I felt like I had to trade everything, and one day, I said to myself, "This is ridiculous. You're chasing too many rabbits. At the end of the day, you end up catching almost none." And from that moment on, I decided to drastically reduce my watch list, and that decision really marked a new chapter in my trading as well. So now, what I suggest to my students is usually, especially the beginners, it's to start with a short but diversified list of instruments, like one stock market index, say the S&P 500, the Nasdaq, or your local stock index if you prefer. One foreign exchange pair, whatever it is, the dollar against the euro, whatever it is that pleases you. One commodity like gold, silver, crude oil, natural gas. And one industry or sector ETF. So like the tech sector or the biotech sector. Again, an ETF is like a mutual fund, but listed on the stock market, and with many different stocks in it. So, and you see what you like best. You concentrate on this short list to begin with, but essentially get familiar again with the trading process, the method, and then when you start feeling ready to move on from there, then you can start extending the list and make it a bit wider. If your main idea is to play individual stocks from the start because you're not interested in anything else, then same thing. Start with a short list of, say, 4 major large caps like the Apple, Facebook, Tesla of this world, or mid caps. But most importantly, they have to be liquid, and then you build up from there. But no matter what you're going to trade or what your short list of candidates is going to be, you have to keep one very important rule in mind. And this basically is super important. You got to concentrate on the movers, and you get to ignore the non-volatile, the boring trading instruments. And I can assure you, this rule is pure gold. You have to go where the action is and not where you wish the action should be. And because at the end of the day, the volatility is going to be your best friend, and that's what's going to help you to catch the good move. Let me show you what I mean by that. Look at this spider material sector ETF. Again, the ETF is a listed fund that represents a mix of companies. In this case, it will be the basic material sectors. It was stuck in a range for weeks, it not going anywhere. Moving average were almost flat over that long period of time. That was the wrong sector to be in, because during the exact same time, if you look at the real estate sector, we had a much stronger market with a lot of momentum going, better performance, a defined trend, moving average with a nice slope indicating the strength of the sector, volume. This was the right sector to be in. And I'm not saying, that it was impossible to make money in the previous ETF sector, but where do you think it was a lot easier to trade and make money? I want to show you also individual stocks. So here, this is an example of the wrong stock to trade, at least during that specific period of time. Again, you can see we're stuck in a range. The moving average are almost flat and doing nothing. And trading that stock at a particular time was not a good choice. But then when you compare this stock to this one during the exact same period of time, and then you can understand where your focus and money should have been. Look at the momentum, look at the moving average slope, the volume. I mean, the stock went 161% in not even 2 trading days. As you can see, that was on the 60-minute bar chart. How about this one? MNTA, a pharmaceutical company, up 68% in less than 3 days. Or let's look at some cryptos, because I've been trading a lot of cryptos over the past 2 years now. The Dogecoin, up 650% in 7 days. That one, WRX, another crypto, up more than 1100% in 6 days. So you see, we get plenty of trading opportunities every day, every week, if we know where and how to look for them. When we find the right candidates, and then we just need to apply the trading setups that we've just learned in tip number 2, which tell us when to trigger the trade, and then use our position management guidelines to help us exit at the best time. And of course, we keep our tight risk management to keep us out of trouble when we're either wrong on the direction or the timing, everything that we've covered in concept number 1. So one of the very important tools that I use in order to basically focus and find the right stocks to trade is called a scanner. Or some people, they also call it a screener. So these scanners, they help us basically to automate this process of finding the right stocks, ETF, cryptos, in a much more efficient way. And by the way, there are plenty of good scanning softwares out there. The one that I use, I'm going to tell you right now, I indicated at the bottom of the screen, the TC2000, Trade Ideas, and TradingView. And now, for those of you who are new to this concept of scanners, you have to understand that they're simply algorithms. They do what you program them to do. And what I mean by that is that you establish the process and the filtering criteria by which basically this software will scan any given market, let's say the US stock market with all the securities or the entire crypto market. And then it will return multiple candidates that will validate your search criteria. So there can be as many different scanners as there are traders out there, because each trader is looking for in different places for different things that match their favorite strategy. And so for myself, I have a list of multiple scanners that help me to filter out stocks to trade according to my different strategies. What you just saw rolling through the screen are some of the scan windows that I use. And so, I run my weekend scan to prepare my A list of stocks, ETF, cryptos to trade during the upcoming week. And during the week, I run pre-market, live trading session scans, which also give me stock candidates to day trade. And this way, I keep like a good top-down approach, focus on top momentum stocks, ETF, cryptos for, either long, medium, or short-term trades. Once I've settled down on my list of names, then I'll just be waiting for my trigger signals according to my 3 main setups and system that we just covered before. So, all right, that was a lot of information that I gave you to digest, especially if you're getting started. But on the other end, I felt like I needed to introduce you to the practical stuff and not the usual useless blah blah that you might have heard before. And I can promise you that, what I shared with you today, they are real gems. They're really, really the essential concepts that you will need to go out there and start trading, investing actively, like a professional. So before we wrap it up, let's quickly recap one last time what we've learned today together. So first, we talked about risk, money, position management rules. Number 1 rule is preservation of our capital, percentage of risk per trade, maximum loss on a daily, weekly, monthly basis. We talked about exit strategies, aiming for a minimum of 1-to-1 ratio and hopefully, getting to that average of 2-to-1 risk reward ratio. Number 2, we talked about the multiple time frame approach along with the 3 main core setups. So how do we establish our strategic time frame? That's screen number 1 that keeps us trading within the main trade direction of the market. And we talked about the entry setups, the reversal, the breakout, the pullback strategies using this screen number 2. And finally, what we just talked about now, the stock market scanners to find a lot more easily and efficiently the right financial instruments to trade in order to basically, to make sure that we focus on where the momentum is and where the action is. So that's it. That's you've got everything you need in order to set yourself on your journey to trade and invest successfully. And I really hope that you'll come out of this workshop with the feeling that you've learned something useful. Please don't hesitate to let me know in the chat if you thought that it was useful. Just type yes. If no, then just if you just type no and tell me that it was a waste of time. But if I manage to teach you something meaningful, if I help you in some way to improve on your trading, then I'm glad, because this was the ultimate goal of this workshop. And I understand that I might have gone a bit fast to squeeze in all the what I wanted to talk about, but I wanted to keep it within a manageable amount of time. And so you might have understood from this presentation that trading can be complex. It's a real hobby. It can become a real passion of yours, or it can even be like a full-time job if you want it to be. But unfortunately, it's difficult to cover it in 1 hour or so. But the fact that most of you decided to take the time today, to take the time off in order to attend this workshop, tells me that you're motivated, that you're ready to learn, to work hard in order to basically be in greater control of your finance. Because you could have decided to stay on your sofa, watch Netflix instead. But the simple fact that you're still here means that you're serious, making this change in your life. And at the end of the day, like I said, anyone can learn to invest and trade in a smarter way. If you apply yourself, you will succeed, and you don't need to be a rocket scientist to become a decent trader. I worked hard, I studied hard in order to get where I'm at now, but I'm certain that you can work hard too. It's just a matter of you dedicating the time to it. But if you're really serious about it, you shouldn't have too much trouble finding some time to do it. And once you got it, it's there for the rest of your life. You own your skills. They're completely transportable, scalable, and this knowledge that you will acquire, it will pay for itself many times over when you start applying it consistently. So, and also, what? You shouldn't worry too much if you did not understand all the things that we covered in the webinar, because at the end of the day, every successful trader was a beginner at some point and had to climb up the learning ladder. So I want to thank again Maria, Christina, the American College of Greece for letting me participate today and share with you my thoughts on trading. I also want to thank all of you, the participants, who took time off your busy schedule to be with us today. And Maria, if we have some time left, I'm happy to take some questions.
So, Oli, first of all, thank you very much. You covered a lot of ground today, and it's always very challenging to present in an hour or so a topic which is so rich and also cover the questions and needs of a very diverse audience, right? Because today we have with us alumni, students, parents, so different levels of knowledge. So definitely this was just a taste. So without any further ado, let me jump into the questions, because we are already an hour and a quarter online. So we have one question. What are your thoughts on crypto trading? You mentioned about that, but what are your thoughts on crypto trading?
Look, I was very suspicious about cryptocurrencies in general, like a few years ago, and like many of my colleagues, in the finance industry, we had basically to learn it, and get on board with it. I believe that cryptocurrencies. I mean, for a start, I believe that there's two different things right now. Like I said, there's 13,000 cryptocurrencies and projects out there. How many are going to make the top, or how many are even basically going to go forward, and be existing in 1 year's time or 2 years' time? I don't know, but probably many will close down or won't do anything. But the one thing that I'm absolutely convinced about is that the blockchain technology, that was introduced by Mr. Satoshi back in 2008 in his white paper, is something that is there to stay, and that will revolutionize the entire world, financial world, and the rest of the world in general. So for sure, because of that, and because of that blockchain technology, some of these cryptocurrencies and concepts and projects are going to be very alive. And like you would say, when many years ago we could participate in the stock market and buy some very stocks in their infancies of the internet, That's going to be the same issue with cryptocurrencies. So I've been actively trading cryptocurrencies for the main reason that they provide great liquidity, they provide great volatility, all basically the measurements that we've talked about during the presentation, and they're great instruments to trade. Obviously, it has to be taken with a pinch of salt, like anything else. And you have to basically be very careful what platforms you're going to be using. Be very careful with what sort of leverage if you're going to be using. I usually go against leverage because I'm not against, I'm not for leverage. I think it's very dangerous, and especially a lot of people don't know how to use that. But they're great instruments, and they're the future. Again, it's going to have to basically to be able to decipher between the big winners of the next 2 to 5 years to come versus the one that won't go anywhere. But again, not more different than finding the right stocks or the right commodities, let's say.
Okay, one more question. What platform do you use and what leverage you have?
What platform do I use on cryptocurrencies?
I'm not sure because it doesn't specify. So if the person, because I don't see any name, if the person who made the question, if you can write on the question.
I'll answer the question assuming that we're talking about cryptocurrencies, but I will also answer the question using other platforms.
It's in general, not about crypto.
Okay.
It's about crypto, sorry. It's about cryptocurrencies.
About cryptocurrencies, okay. So I use basically two main cryptocurrencies platforms that are Coinbase and that are Binance. And the reason why I'm using this platform is because Coinbase is the only, to my knowledge, the only one legitimate platform in US regulated by the SEC. And I like the fact that basically, also I like the team that's running the business. And Binance is because it's the biggest platform out there. Biggest platform in terms of volume, biggest platform in terms of cryptocurrencies that you can trade, and it had reached like such a level of importance. And I'm using also a third one. Sorry, I forgot about that. FTX, which is also a good platform. I like the team. I think it's pretty secure, but you have to be very careful of who you're going to be using. I think that Poloniex has been a good platform. What else? Kraken is also been an old platform out there in Europe, and without too many issues. But you have to do your due diligence work and make sure, because the cryptocurrency world can be a very, very nasty word. I mean, again, I can share that with you, but I had a phone call from a friend of mine 2 weeks ago telling me that he got scammed for a very, very big amount of money on cryptocurrency. So you have to be extremely careful because it's still a very much unregulated environment, and therefore you have to be double careful on what you do. So that's to answer the question about the cryptocurrency platforms.
Okay, so okay, 2 more questions because I'm conscious of the time, and if there are any more questions you can send them to us, or you can write them here, and we will answer them in the follow-up email. So, question from Paris Lorenzo. For continuation patterns, do you use price targets after consolidation breakout? For example, after an ascending triangle, I normally set the price exit target to the breakout point and the difference of the trend lines once the ascending triangle started forming.
Okay, I will answer that question very quickly. I don't use triangles, so I know what she's talking, what it's talking about, but I don't really use triangle. But yes, I mean, this is in technical analysis. That's usually what you will use as a target, as basically the base of the triangle, and that's what would be that would be your first target. In my trading, to be honest, I try to basically keep the patterns very simple. I mean, you can very quickly overcomplicate your trading, especially in technical analysis. I shared with you during this presentation one of the patterns that I use, and that's probably one of the few patterns that I use in Japanese candlesticks, which is this bullish engulfing pattern, because it helps me basically when we reach these areas. And I was talking a lot during our presentation about convergence. convergence for me is basically these areas on your charts where you will bring a lot of information together. You might have like the moving average that basically start converging with the price support that might also converge with Fibonacci numbers. We haven't talked about that, but some of you, I'm sure, will know that. And these areas, that's where basically I will start, looking. When we reach these areas, that's where I will start looking for the signal to get in position. And then my targets will be, again, based on the several level of conversions that appear on my price charts. I know what she's talking about, but I don't like to use these exact formulas because at the end of the day, I feel like lots of times they don't follow this pattern or these exact patterns.
Okay, Oli. Oh, okay. We have 4 more questions, but
I'm okay. I'm fine if you want to.
Okay. So maybe 2 questions, and then the rest we answer in the follow-up email. So one question from Evangelos Paskouras. Okay. So the question is, how do you get informed regarding companies and their stocks? And how can we filter info in order to acquire the right data as traders?
Can you reformulate the question again, Maria? Sorry.
How do you get informed regarding companies and their stocks? How do you get information about the companies and their stocks? And how can we filter the info in order to acquire the right data as traders?
Look, it's a how do you acquire basically info on the stocks? I mean, there are plenty of. I'm sure that you'll have the webinar on replay, and you'll see. But the 3 platforms that I use mostly are TC2000, which is basically a very old US platform for US stocks. You can only basically look at US stocks on that, and on this platform, you can basically scan any type of fundamental information about the company or technical information about the company. So in my case, because I'm a technical trader, I would be looking for stocks that achieve momentum, that basically achieve certain convergence that I've talked about, indicating me, that's the stock that I'd rather trade rather than this one. Indications of volumes and minimum of volume. So these are sort of like filters that I'm using in my criteria in order to basically filter through the list of stocks. But there are all other trading scan is also I'm sorry, trade ideas is also a famous scanner. A bit expensive, so for starters, I would basically not mention that. There's one trying to remember the name now. It will come back and I will communicate the name, but it's also, if you Google basically stock screener or scanner, you will have basically a few good softwares out there that are free, and that you can basically start using. And because again, like I said, the scanning process can be very subjective in the sense that, I'm looking for something, I'm looking for certain filters and criteria that fit my strategy, but maybe this person who's asking me the question is more on the fundamental side. Maybe he's looking at only fundamental information, like, I don't know, the capitalization of the company, the earnings per share, the quarterly earnings reports, and this sort of thing. So you have to basically make it your own at some stage. But there are some good softwares. I just forgot that there's one that's if it will come back, and I will communicate that to you by email, and then you can pass it on.
Perfect. Okay, Oli, we have more questions, but as I said, in the interest of time, we will address them in the follow-up email. So thank you very, very much for this insightful presentation. I think we learned a lot, even us that we don't know about trading. So thank you all for joining us. We will send you the video recording, as we said, and other ways to stay connected, because today we had a really diverse audience, right? So I would like to encourage all students, not only the alumni, but also the students and the peers' parents to register on our networking platform, acgconnect.org is the link, and we will send it to you over email as well, to receive invitations, to find mentors, to promote your business, to find other alumni, to join the communities, because we have a lot of communities based on academic subjects and work-related subjects. So different communities, and most probably we need to create a trading community as well on the platform in the future. After all, our school, the American College of Greece, is the only school that has a simulated trading room with Bloomberg licenses, Reuters licenses, a minor on financial trading. And I also see Annie Triandafilou, who is our dean of the School of Business and Economics. So, you know, I think all these are very important things. We will include some information in our follow-up communication.
I even had the chance to also teach some of the undergrads once in this beautiful training room of yours. I mean, it's quite impressive, I must say. You know, I mean, it was really reminding me the good old days. You know, back in London and New York.
Indeed. Thank you very much once again, Oli. So continuing our diverse topics, as I said at the beginning, the topic of our next webinar has nothing to do with trading. It's all about wine, believe it or not. It's near the Christmas season, so we are co-organizing it with the Peers Parents Association on December 10, before Christmas. And we are going to have wine experts and peers parents with us, Eleni Blouchou, who is also a BGC alumna, and Lenga Grigoriadou. And you will receive the invitation in the next few days. And if you register on ACG Connect, you're going to receive it earlier. So thank you once again, both Oli and all of you, for joining us. And we wish you a very nice evening.
Thank you, Marianne. Thank you, everyone.
Thank you.